Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be analyzing Cintas stock, ticker CTAS. This one came in by request down in the comment section of one of my other videos. And so now I'm going to share a video analysis. If you have a request you'd like me to take a look at on the channel, just put it down in the comments. I'll get it on the whiteboard behind me. Still have a couple dozen I still need to work through here. But eventually I will make a video, and if it's a stock that's in the S&P 500, I post those on YouTube for free, and if it's not, I post the rest on Patreon. And if you join there for $5 a month, you can request stocks that aren't in the S&P 500. There's also a free tier over on Patreon now, so you can just go check that out. I'm gonna be doing some extra things there here in later on this year at some point when I get a little bit more time. But joining there is free, so that's worth checking out as well. As always, this is not individual investing advice. This is just how I analyze stocks. Cintas is going to be a pretty interesting one to look at because most of the stocks that I've had lately requests for have been trading quite a bit off their highs, and so they've looked really cheap for one reason or another. And often in the videos, I kind of end up explaining why they might not be quite as cheap as they look. That's kind of the pattern that we've been having. So Cintas is almost at an all-time high now, so it's totally different than the other ones, and so it's going to be a little bit of a different type of it's the same type of analysis, but a different type of outcome, I guess. So let's take a look at it. I'm going to be using fast graphs here for a lot of this. I do have a 25% off affiliate link down in the description if you've never tried fast graphs before. And I think they also have like a free trial that's part of it too, so you can just try it for free. I've used it for several years now, and it helps, especially with an earnings analysis like the one I'm going to do with Cintas here. So just taking a look at the historical earnings pattern. This is mostly an upward growing pattern, which is what we want to see. The dark green area on the fast graph represents earnings per share. The only time they really had a decline was during the Great Recession, which makes sense because these guys do. Let's see what they actually have. So support services. So I've always known Cintas as doing like employee uniforms, like rugs. They would come and like replace like our rugs and things like that. Mop heads and sort of cleaning equipment and things. So like supplies that you might need to run like a business. That just makes your life easier, where they come in like once a week or on a schedule and kind of help you take care of the things that you need to take care of. I used to work at a hotel this had to be like 10 years ago. And they started right about when they started getting this extra growth, I'd say maybe around 2015. I'm just going from memory here, but I'd be there. I'd be like kind of the person in charge. And so they wanted somebody that knew like first aid and CPR, because it was a pretty big hotel actually. So it was good to have somebody if there was an emergency to have kind of a first responder there. And Cintas started, I think they were the ones that came in and did the training for that, which historically I was a lifeguard and stuff for many years when I was younger. And so we'd always you have like the Red Cross, maybe the American Heart Association, maybe like the YMCA or something like that would be the ones that would do that type of training in the past, it seemed like. And so it was interesting to see Cintas kind of combining that type of service. Already they have the relationships with these businesses to maybe add these other types of services. I didn't do a bunch of research to see everything that they were doing in terms of expanding their kind of service offerings. But I do think that probably helps explain this acceleration in their earnings growth during this time period. So it was really smart. But that also explains why the earnings fell, over 30% during the Great Recession, because businesses were like closing down and cutting back services and everything. So you can expect that would happen to them as well as a service provider. But other than that, you couldn't ask for a better stock. Since then, if you would have just picked it up maybe before that acceleration started, down here that's at a 15 PE and held it through here, you would have gotten nearly a 30% CAGR per year. But now a lot of that is multiple expansion because now it's at a 45 PE and then it was a 15 PE. So just in multiple expansion, that you get a triple basically. And then obviously earnings have been growing during that time as well. So really high quality business, pretty straightforward business, I think. Will likely be economically sensitive to some degree during a recession. I don't know if it's total then a new recession will be totally comparable to what the old one was, but I would say probably at least as so. So you're looking at a moderately cyclical business is what I would call it. They don't really have any debt, like relative to cash. So that's not much of a factor. So it's a pretty straightforward analysis. And investors, other than this little downturn during the Great Recession or during the COVID crash, have been treated to very great growth. So usually when that happens, nobody wants to sell, and oftentimes people want to buy, and they'll even buy based on the momentum, which is what we're seeing probably right here this past year or so. Okay, so that's kind of the lead up. I would also look at, so even though earnings didn't fall that much in 2020, the stock price fell 45, probably close to 50%, honestly. That's the 45 there. Let's look. So yes, so the low was 154. I'm not sure. Yeah, so about 50% actually in 2020. So that's a lot deeper than the market. So we know now some of that is just has to do with the particular COVID problem at the time. But because businesses were like closed, a lot of them were closed or they couldn't open or the inside of them weren't open. So some of those services might not have been needed. It looks like that they still managed to grow earnings, 7% that year. But so you can see why the market would be extra jittery about that. But at the same time, their valuation going in was pretty high still, 38, not as high as it is now. And when you have those really high valuations, any kind of problem can cause a very quick decline. Let's take a look and actually see what the decline was back in the Great Recession, even though it wasn't. So maybe back here we had like a 32 PE, not quite as high as it is now. And so we're looking at like a 65% decline. So I would assume if I own this stock that the stock price could fall deeply in like a recession scenario, especially off these really kind of premium priced high. So lots of downside danger with the stock price. Really no worries with the business. The business isn't going to go anywhere. I think investors have kind of who don't want to sell the stock understand that or are reluctant to. So the business is safe. It's really just a matter of what kind of returns are you going to get if you're buying at this price. So let's look at the valuation now. We have that 45 PE. So the way I do this is I take an earnings growth estimate, which is 16% for me, which actually, if you look at the projections, analysts are only looking at 10% earnings growth from here. So if they're right, I'm way on the high side in terms of what I'm estimating for future earnings growth here. But if we just pull this in, if we look at what they've done the past decade, they've done 18%. So in that sense, I'm a little bit lower than what the future or what the past has been able to do. Although I do control for buybacks. They bought back about 13% of shares outstanding. That's where the difference between probably my estimate and the fast graph estimate comes in. But really, they've done great the past decade. If earnings growth grows to 10%, I fully expect this valuation to come down. But I'm not assuming that. So I just want to make that pretty clear. I'm being pretty optimistic, I think. Inflation might push up that earnings growth that the analysts expect too. So 16%, which I think is fair, is my earnings growth estimate. There's not much debt to account for. I really only adjust up the price $40 to 701 from the tiny amount that they do have. The real thing here is like the PE ratio is in the 40s. So that's going to produce a pretty small earnings yield of only 2.13%. So the way I like to think about this is if I bought the whole business for $100, it would pay me $2.13 on my $100. I pull the first year's growth forward of 16%. So the first year I would expect to make $2.47 on my $100. What I want to know is how much of that money could I collect from the earnings as an owner of the business over the next 10 years. So that's 213 growing at 16% for 10 years. And we would have on our $100, it would grow to 152 or 153. If you plug that into a CAGR calculator, should give you a 10-year CAGR expectation of about 4.3%. So below 5% is where I would start thinking about selling a stock based on valuation most of the time. Given that I'm using a pretty generous earnings growth rate, I think that, yeah, I mean, if I owned this, I would definitely be I would be trimming in most circumstances. Maybe a person has just decided that they just want to hold this for however long and they made a ton of money on it. They don't want to pay taxes and they're just going to hold it. I totally get that. So I'm not telling anybody what to do, but to me, the valuation is high and probably high enough to sell. I mean, I can get 5.3% on cash right now. And the long-term projected return on this stock is, way under that. I would say if inflation comes in a lot higher and Cintas is able to pass that cost on, then this could be boosted if inflation comes in higher than it did the past 10 years. So maybe that could get that up to more like 5 or 6%. Still not a great return at this valuation. If I was looking to buy it, I would wait for a lower valuation. Just a standard buy price right now, which would get this over 8%, which is my threshold. That's with a margin of safety, is about $302 per share. So about 50% off where it trades now. I mean, it sounds like I would be asking for a big discount, but if you cut the PE in half, that's still a 22 PE ratio, which isn't cheap, right? I mean, it's definitely traded lower than that in the past. So this seems pretty reasonable to me. Now, we saw how much it's traded off its highs and during past recessions. So if we have a deep recession off these very lofty highs and earnings fall 35% like they did during the last recession, the stock could fall very deeply. It could fall 75%, I think. And that would be if you knew you were in the middle of a recession and the price was diving and you didn't see the end, then this could be another entry point. I think this $300 level is probably pretty decent if the world isn't falling apart. And an investor could do well with a business that's this steady for the most part. But if you do get a chance, and we do have a calamity, this one you should pretty easily be able to come and safely buy and maybe take a bigger position, way down deep, or just layer in from 300 down to 170 or so. So that's my thoughts on Cintas. If you thought this video was useful in terms of the valuation and trying to take into account that growth. Now, the rest of the markets, we saw this was like at a 4.5 CAGR. What was I? A little lower than that, 4.3. The rest of the markets at like 5.5 in terms of the S&P 500. So it's not like the rest of the market's like super cheap either. I think probably when it was trading in this kind of 35 PE ratio or range, that's about where the rest of the market is now. So if the stock price came down to, dropped $100 or dropped like $200, then it would be back in line with kind of the rest of the market. So it's not like you could just sell it and go out and buy something that's super cheap right now. There's not a whole lot out there really. So you'd have to think about how much cash you'd be willing to hold and how long you want to hold it and things like that. But I definitely wouldn't be buying at these levels. The risk reward just doesn't look, mostly the reward doesn't look good enough is how I would frame it. All right, if you found this useful, hit the subscribe button and the like button. And if you have a request, put it down in the comments section and I'll get it on my list and I'll make a video for you. Later, bye.